if I told you that every time you walk into your Canadian bank looking for mortgage advice, you're not just a client, you're actually more of a target? It's true. They have a playbook and it's designed to make you pay thousands, sometimes even hundreds of thousands more than you have to. In the next few minutes, I'm going to expose that playbook and I'll show you exactly how they rig the game and 3 crucial questions you have to ask them to turn the table and keep that money in your pocket where it belongs. This isn't just about getting a low interest rate. It's about hidden traps and fine print that can lock you into a financial cage. The biggest mistake you can make as a Canadian homeowner is assuming your bank is on your side. Let's be clear, your bank is a very profitable business, and its #1 goal is to make as much money as possible. When it comes to mortgages, they've got this down to a science. The whole game relies on 2 things: your loyalty and your convenience. They know you're busy. You trust their brand, and let's face it, shopping for a mortgage is confusing and often gives you a headache. So they make it easy. They send you a friendly renewal letter in the mail with a special rate, hoping you'll just sign it and send it back without any second thoughts. And a lot of Canadians do just that. They don't realize that renewal letter isn't a gift, it's an opening bid. And it's almost never the best option. This is the first play in their playbook, the loyalty penalty. The rate they offer their loyal existing clients can sometimes be higher than the rate they'd offer a brand new customer walking in off the street. They are betting that you're not going to bother to shop around. And often when you do, they generally sharpen their pencil. So essentially, this interest rate is basically an appetizer. The main course, where the real damage is done, is hidden in the fine print. This is where they lock you in. First, they can trap you with highly restrictive terms. A common one is called a bona fide sales clause. Lenders sometimes offer slightly lower interest rates, but in exchange, they add a clause that says the only way you can break your mortgage before renewal is by selling your home. This completely removes your ability to perform something called a no-fee switch or collateral transfer, where you can move to another lender for better rates mid-term. It's basically the equivalent of a mortgage headlock. And if you see this clause, my advice is run. Just run the opposite direction, because it is never worth the slight discount you're going to get on the interest rate. The second one, and in all honesty, a little bit more of a sneaky one, is the rise in collateral charge mortgages. Now, these are great if you have a readvanceable product with a home equity line of credit or something along those lines, and when you're in a really stable rate environment where rates aren't going up or down or anything like that. But at the same point, they have restrictions to them. So how it kind of works is a standard mortgage is registered for the exact amount you borrow. Let's say you borrow $500,000, there's a mortgage charge on your title for $500,000. But with a collateral charge, the bank might register that loan for up to 125% of your home's value. There are a couple lenders that actually do that, unless you specify that they don't. So on that same $500,000 mortgage, you may have a mortgage registered for significantly more on the title of your home. Here's the trap. A collateral charge can't be switched to another lender at renewal or midterm. With a standard charge, you can often transfer your mortgage to a competitor with minimal to no cost. I'm talking no legals, I'm talking no appraisal. With a collateral charge, you typically have to pay a form of legal fees, either through First Canadian Title or F&F or one of the other title companies, and they're going to discharge the mortgage and register the new one on title. On top of that, if you have a balance on that line of credits aren't portable. And if you have to increase the balance of your mortgage, you're therefore doing a refinance. You can't do the no-fee switch option. So it kind of locks you in a way that makes it almost impossible to access that no-fee switch option. Now, as a caveat, there are some lenders that will allow you to do a no-fee switch with a line of credit. Basically, what they'll do is they'll switch your mortgage over. You're going to have to pay the FCT fees, but at least you can move that HELOC balance into a new HELOC. So there are options, but if I'm being honest, that's one lender out of 60. So it does kind of lock you in. If you're looking at collateral charge mortgages, make sure it's the right move for you. Make sure it's the proper mortgage for that time, and make sure there's no potential for you to need to switch your mortgage before your term is up or at renewal. So how much does this part of the playbook actually cost you? Let's talk some real numbers here. First, the rate itself. By late 2025, the Bank of Canada's key interest rate is down significantly from the peak of 2023, but don't let the headlines fool you. The gap between the bank's offer and the best rates on the market is usually different. Let's imagine you have a $500,000 mortgage coming up for renewal and your bank offers you a 5-year fixed at 4.45. It seems okay. But let's say there's a mortgage broker who finds you a rate at 4.04% from a different lender that also has better terms. At 4.45%, your monthly payment is about, Let's say $2,753. At 4.04, it's $2,640. That's a difference of $113 a month. And over the course of a 5-year term, that's over $6,700 in savings. Think about it. What could you really do with $114 a month? Well, you could add that to your mortgage and pay it down faster, cutting your amortization down by around 2 years. Or you could build an investment account and have money start working for you. If you take advantage of compound interest, in 20 years, that account will be worth around $67,000. It's your money and it should be building your wealth, not the bank's. But now let's talk about the most devastating tactic and the one I personally hate the most, because most people don't actually see this coming: the penalty trap. This is where the banks make a small fortune. A surprising number of Canadians, some studies suggest around half, break their mortgage term early. It could be for a new job, a divorce, just a refinance to pay out some debt or do some rental work on the house. And when they do, they get slammed with what's called a prepayment penalty. And the banks know this. If you have a variable rate mortgage, the penalty is usually just 3 months interest, which is simple enough. But if you're in a fixed rate mortgage, the penalty is the greater of 3 months interest, or something called an interest rate differential, or IRD penalty. And how the banks calculate the IRD penalty is it can be downright deceptive. Let's say you have a $500,000 mortgage with your bank and you're sitting at a 5% contract rate, and you have 3 years left, but you want to refinance to access better rates. To calculate your penalty, the bank doesn't use that 5% rate. Instead, they go to find the posted rate from when you signed your mortgage. So let's say it was 6.5%. Then they compare that to the current posted rate and current rates available for a 3-year term. So let's say maybe 4%. They've just created an artificial rate difference of 2.5%. Based on that, the penalty could be using $500,000 multiplied by 2.5 multiplied by 3 years, around $37,500. Now, let's take a look at a lender that's a bit more fair, the kind that brokers often work with. They use your actual contract rate of 5% to compare it to the other current real-world examples of a 3-year term. Let's say it's 4%. The real difference is 1%. So the penalty, $500,000 multiplied by 1% multiplied by 3, is $15,000. That's a difference of $22,500. Same mortgage, same situation, but a completely different result based on hidden calculation methods that aren't necessarily easy to understand or easily presented when looking at mortgage commitment letters. The interest rate is what they advertise. The penalty calculation is what they hide in fine print, and they make buckets of money off of it. Okay, now that we know the playbook, it's time to learn how to flip the script on them. There are 3 levers of power you can pull to beat these banks at their own game every single time. Lever number 1, never ever accept the first offer. That renewal slip that shows up in your mail, it's not a gift, it's a test. Your first move should always be to call your bank and ask, is this the absolute best you can do? You'd be shocked how often a better rate just magically appears once they know you're paying attention or shopping the market. Lever 2, become a free agent and use a mortgage broker. This is the single most powerful move you can make. A mortgage broker doesn't work for one of the banks. They work for you. Their job is to shop your mortgage at a wide network of lenders, including the big banks, credit unions, broker-only lenders, monoline lenders, and everything in between. And some of these lenders you wouldn't even know about. This forces competition, which drives rates down and gives you better terms and conditions. Now, you're probably thinking, what's the catch? How do they get paid? And it's a totally fair question. For most standard mortgage transactions, the broker's service is completely free to you as the customer. The lender they place the mortgage with actually pays them a commission. Now, for more complex situations like private loans or alternative lenders or construction loans, there might be a fee applied to that the broker is going to charge to be reduced from the mortgage amount, but this is always disclosed and talked about upfront. A good broker is going to lay out all your options, examples, and pros and cons, and empower you to choose what's actually best for your finances, not just what's best for the bank's quarterly profits. And now for lever 3, scrutinize the fine print and ask them these 3 questions. Force them into admitting the things that they do. Before you sign anything, you need to become an interrogator. And here are 3 non-negotiable questions you need to be asking. The first question you want to ask is this mortgage registered as a standard charge or collateral charge on my title? If they say collateral, follow up with how much is it being registered for? And can you tell me in dollars the exact cost I'll have to pay if I want to switch to another lender when I renew or midterm? And try and get this in email form so it's in writing. That's a little key tip for you. Question number 2 is, how is your prepayment penalty calculated? And be specific. Do you use my discounted contract rate or your bank's posted rate to figure out the interest rate differential penalty? The answer to this question could literally save you tens of thousands of dollars. Question number 3, what are the exact prepayment privileges? Don't settle for a vague answer. Ask exactly what percentage you can pay down each year and by how much you can increase your payments without getting hit with a penalty. Also make sure to ask things like, is my mortgage portable? Is my mortgage assumable? These are key details, and I know with any mortgage that I set up, I go through these with a fine-tooth comb because I want to make sure everyone understands exactly what they're signing for. And here's a bonus question for you. Ask them point blank. What are they going to do to help you monitor your mortgage? And will they reach out with opportunities as they come up to lower your interest rate and save you money on interest, even if it's with another lender? You want to know the answer? They won't. The person at the bank works for the bank. They're a bank employee. The bank's profits are directly tied to their employment and what they make. When you ask these questions, you send a really powerful sign to these people. You're not an easy mark. You're an informed consumer, and you're not going to settle for some crappy mortgage. Now you know the truth behind the bank's playbook, which puts you in a much stronger position. But the mortgage world is always changing. You need to stay ahead of the game. Make sure you hit that subscribe button and turn on notifications for my next video, which is where I break down should you buy now or wait. It's going to be a 2026 Canadian housing market breakdown that I think you're going to be really interested in. Okay, before we wrap this up, let's do a quick recap on the 3 truths about, banks and the things they hope you don't figure out. First, your loyalty is often punished, not rewarded. The first renewal offer is generally a test, not their best deal. Always dig, always shop around, and always ask hard questions to try and get you what you deserve. Second, the biggest costs are always buried in fine print. Sneaky penalty clauses, collateral charges, bona fide sales clauses. These are designed to trap you with that lender so they can continue making money off you. Understanding these is crucial. And third, you hold the power. By using a mortgage broker and asking tough questions, you force the lender to compete for your business, which can save you a small fortune. The banking game is designed to be complicated, but it's not unbeatable. You now have the knowledge to protect yourself and your family's financial future, and to put you in the driver's seat versus having the bank take the wheel for you. But now I want to hear from you. Have you ever felt pressured by your bank's mortgage offer or been shocked by hidden fees or charges? Share your stories in the comments below. Your experience could help someone else avoid the same traps. And if you found this video valuable, please consider sharing it with a friend or family member who needs a mortgage or is looking for mortgage advice. It helps me grow the channel, and it helps me spread more information to help people avoid paying big fees. Once again, thanks so much for watching. My name is Myles Nowik of the Nowik Mortgage Team, powered by Indy Mortgage. We'll catch you on the next one.